Welcome to the Riskwiser Zone, the show where we dive into the world of finance and explore the latest trends and developments that affect your money. I'm your host, Lewis, and I'm excited to share today's top stories with you. We're starting off with a look at the bond market, where a significant shift is underway. The yield curve, which measures the difference between short-term and long-term interest rates, has been steepening in recent days. This means that while short-term rates are falling, long-term rates are rising, creating a wider gap between the two. Now, you might be wondering what this means for you. Well, a steeper yield curve can have both positive and negative effects on the economy. On the one hand, it can indicate a brighter economic outlook, with banks more willing to lend and consumers more confident in their spending habits. On the other hand, it can also make borrowing more expensive for companies and individuals looking to finance long-term projects or purchases. The current steepening of the yield curve is being driven by concerns over government debt and fiscal stimulus. With governments around the world increasing their spending and borrowing, investors are demanding higher returns on long-term bonds to compensate for the added risk. This is pushing up long-term interest rates, even as short-term rates remain low. So, what does this mean for your investments? If you're looking to borrow money for a mortgage or a long-term loan, you might not see the full benefits of lower short-term rates. And if you're an investor in long-term bonds, you could see your returns increase as interest rates rise. We'll be keeping a close eye on this developing story and exploring its implications in more depth throughout the show. For now, it's clear that the bond market is sending a complex signal about the state of the economy, and investors would do well to pay attention. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of corporate earnings, where some big names have been making waves with their latest reports. Let's take a look at what's been happening. Qualcomm, the chip designer, saw its stock fall around 8% in extended trading after its forecast came in lighter than expected. Despite beating analyst estimates on the top and bottom lines, a memory chip shortage is weighing on the company's outlook. This shortage is being driven by data center developers scooping up chips and chip makers shifting production to cater to AI demand. On the other hand, Eaton Corporation, a power management giant, saw its stock price spike after reporting that its backlog of orders just keeps growing. The company's CEO attributed this success to demand from AI hyperscalers, with data center orders roughly tripling in the fourth quarter. This is a great example of how the AI arms race is driving growth in certain sectors. We're also seeing some positive news from Snap, the video messaging app, which reported revenue and earnings per share that beat Wall Street estimates. The company's strong holiday quarter was driven by a boost in ad spending. Meanwhile, Alphabet, the parent company of Google, has announced a significant increase in its 2026 spending forecast, with a major focus on AI. This move is seen as a bold bet on the future of artificial intelligence and its potential to drive growth for the company. As we can see, the corporate earnings landscape is complex and multifaceted, with different companies facing different challenges and opportunities. It's essential to stay informed and up to date on the latest developments to make sense of it all. Welcome back to the Riskwiser Zone. As we wrap up today's show, I want to bring to your attention a rather intriguing development in the world of art and politics. It appears that the White House has floated the idea of creating an expanded display featuring multiple images of President Donald Trump at the Smithsonian's National Portrait Gallery. According to reports, this would be in addition to his official portrait, which was recently updated to a more flattering image. Now, it's worth noting that the National Portrait Gallery does regularly include multiple images of past presidents in its permanent installation. However, the proposal to dedicate an entire gallery to President Trump has raised some eyebrows. The White House has stated that the president receives a significant amount of artwork from patriotic Americans and wants to showcase these creations throughout the nation's capital. The Smithsonian, on the other hand, operates independently of the executive branch and has not received an official request for such a display. The institution's standard practice is to debut commissioned portraits only after a president has completed their time in office. It's also worth mentioning that tensions between the White House and the Smithsonian have been simmering since the start of President Trump's second term. The president has criticized what he perceives as ideological bias in museum displays and has pressed the institution for detailed information about its content and finances. As we consider this development, it's essential to remember that art and politics can often intersect in complex ways. While some may view this proposal as a celebration of presidential history, others might see it as an attempt to shape public perception or promote a particular agenda. Ultimately, the decision to create an expanded display featuring President Trump will depend on various factors, including the Smithsonian's curatorial vision and its commitment to maintaining independence from political pressure. As investors and risk-aware individuals, we must stay informed about such developments and consider how they might impact our understanding of the world and our investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.